this by what? By the PV. What is the PV? What is the PV of that cash flow? This is 300. 396.
396.
Then I multiply this by 100. Multiply by 100. So what percentage do you get?
1.9.
1.9%. Okay. So you can see that the sales volume is more sensitive, because remember we say that the lower the sensitivity margin, okay, the more sensitive the parameter is to the decision that was undertaken. So we can conclude with this by saying that if the sales volume, so we can conclude by saying that if the sales volume, okay, reduces or decreases by 1.9%, okay, the project decision will change from accept to reject. Should the sales volume decrease by 1.9%, the project decision will change from accept to reject. Okay. Then lastly, so you can see sales volume is more sensitive because the lower the sensitivity margin, the more sensitive that variable is to the project decision. Okay, because it is too close. Any slight fall by 1.9%, the project will no longer be viable. Okay, so meaning that particular attention has to be attached to this. You must try as much as possible to ensure that your sales do not fall. Falls by 1.9, then you no longer, the project decision will no longer be viable. The project will no longer be viable. Now, lastly, sensitivity to selling price. Now, the sensitivity selling price will be similar sensitivity to sales volume, because now the selling price is 12.5. Okay, so meaning that our 12.5 we need to multiply by the units sold so that we get our total sales. So our sensitivity sales volume will be similar to what? So the sensitivity selling price, this is similar to the sales volume. Because once you have your selling price of 12.5, you need to multiply by the sales volume of 10,000 so that you can be able to compute that sensitivity margin. 10,000 units so that you get your 125. So meaning that to still be this, Okay. So meaning that if the sales price, the conclusion would be that if the sales price, if the selling price decreases by 1.9, the project decision will change from accept to reject. Okay. Now, I have done example 1. So I will require you to go and do example number 2. And it is similar to what we've just done. So you do this number of sports world company is considering to investing 500 in equipment to produce a new type of ball. Sales of the product are expected to continue for 3 years, at the end of which the equipment will have a scrap value of 80,000. Sales revenue of 600,000 per annum will be generated at a variable cost of 350, and annual fixed costs will decrease by 40,000. Determine whether on the basis of the estimates given above, the project should be undertaken, assuming that all cash flows occur at annual intervals and that Sports World Company has a cost of capital of 15%. So you need to first evaluate the above project using the variables given here. Okay, the initial outlay is 500. Then you expect to receive sales for the 3 years, and the sales revenue is 600,000 per annum. So meaning that in this case, you will have, if I can give maybe a hint, you will have your layout like in this form. Let me just take this. Because each variable you need to look for the PV, because remember when you are computing the sensitivity of each variable given there, you need its present value. So meaning that your format should be in this form. So you have the initial outlay. The initial outlay, the discount factor itself is 15%. Okay. The initial outlay is 500,000. 500. And the discount factor, the period, they are saying 3. So this is going to be 1 at 3. So meaning that you're going to have sales revenue. Sales revenue. So sales revenue is 600,000 per annum. Okay. And it is an inflow, then this initial outlay is an outflow. Of course, the discount factor will change. Here it is no longer 3.17, but you need to go to your tables and look for 15%. 3-year annuity factor at 15%. Okay. Then they are also saying that the variable cost, so mean that the variable cost in this case from year 1 to 3, they are saying it is what percentage? The variable cost is what is the variable cost? 350. Okay, and of course for it is an outflow. So you go so look for its discount factor. In other words, at what percentage? Okay. Then another one is fixed costs. You will have the fixed costs. So fixed costs. So from year 1 to 3, you have fixed costs. Fixed costs in this case is given as what? Fixed cost is given as 40,000. And it is also an outflow. So you also look for the 3-year annuity discount factor at 15%. Multiply it with the cash flow, get the PV. And here it is also an outflow. Okay. So this is also an outflow. I'm just giving you the guidelines so that you go and do the number. Then now with this, I also have the scrap value. Okay, because at the end they're saying that the scrap value is 40. No, it is what is the scrap value? The scrap value is what?
80.
The scrap value is 80. So meaning that you come here, and of course the scrap value is an inflow. So this is got in year 3. Okay, because it is not going to be, now you're not going to use annuity tables, because this is a cash flow that comes in at once, and that is at the end of the year, because I say that at the end of which the equipment will have a scrap value of 80. And since our period is 3 years, okay, because I'm saying 3 years, since our period is 3 years, so meaning that this 80 is going to be got in year 3, because that is the end of the investment. So meaning that I will have scrap value, and it is 80. And this scrap value, of course, is an inflow because money is coming in. Okay, that is what you're obtaining from the equipment after scrapping it off. So meaning that when I am determining my discount factor here, I will not use annuity, but I will go to the present value tables. Okay, the ones that are in 0 series. I look for the present value discount factor at 15% for 3 years. So don't use annuity when it comes to scrap value. You only use annuity for sales revenue, for fixed variable costs, and then fixed costs. Then multiply your discount factors with the cash flows and get the PVs for each of the cash flows given. And once you've gotten your PVs, sum up your PVs and get your NPV. Okay, and once you get your NPV, once it is positive, accept. Once it is negative, you do what? You reject. Okay, once it is positive, accept. Once it is negative, reject. And then part B, you'll be looking at the sensitivity of each of these variables here, given here. Okay, the sensitivity margin for each of the variables for the investment decision to change. Like the way we did for the previous, if you come here to initial investment, to look at the sensitivity, meaning that you will get the NPV that you would have gotten above there, you divide by the PV of the variable. under consideration. Okay, and then you multiply by 100. For example, now I will get the NPV here for whatever I would have gotten here, then I multiply by the PV. For this case, it will be 500. Okay, because if I get, remember for the initial outlay, we said it is 1. So if I get 500 times 1, I will get 500. So mean that I will get the NPV, the one that I would have gotten up, I divide by the PV of the variable under consideration, which is 500. Then I multiply by 100%. So meaning that whatever percentage I get, then I should be able to make my conclusion. Okay, and since this is an outflow, if there is any increase, the percentage that you get, if there is any increase, then that means that your decision would change from whatever you would have gotten up there. So whatever you get here, it is what gives you how you're going to conclude down. But for costs, if you are dealing with outflows, if the outflows increase, then that means that your decision will change. If it was, for example, here, a positive NPV. Okay, so please, I think this one is clear. Can you be able to complete this number? Any issue on this, on sensitivity? Yes. Can I have feedback, please? Otherwise, I might be talking to myself and find that.
Thank you very much, and good morning. So I think if anything, the challenge might still be with how to conclude. It's quite unclear yet, the conclusion, but I think I've been able to appreciate the illustration and how you've guided us through. Now, when it comes to the conclusion, there is where maybe you may need to throw some more light. I don't know about the rest.
Because I said conclusion, assuming that my NPV was positive here. Because there are two scenarios. You can either get positive or negative. Okay. If it is negative, then there is the project is not viable. But if it is positive, then that means that the project is viable. So if you go to look at the sensitivity, because remember we are looking at these variables, initial outlay or initial investment. We are looking at our sales revenue. We are looking at variable costs. We are looking at fixed costs. And we are also looking at that value. And when I'm looking at sensitivity, I'm looking at how sensitive. Now, assuming I got a positive NPV here, and that means that the project is viable, is worth undertaking. Then I am looking at the sensitivity. How sensitive is each of these parameters we are given to the decision? Okay, how sensitive will it with the parameters given there be to my decision that I've taken? And when I come to initial investment, remember now, initial investment, it is an outflow. Money is going out. So meaning that if you compute the sensitivity, when you come to conclude, okay, you are looking at if that initial investment increases further, then it is going to change your decision. Because for outflows, if the outflows are increasing, remember we say that sensitivity looks at one variable at a time. After that is one of the drawbacks. We assume that the other variables have remained constant. Okay, they have not changed. So meaning that my initial outlay if it increases by a certain percentage, and then you find that these other variables, the sales revenue and other maybe these costs have not changed, then that means that my decision will no longer be viable. It's going to change from accept to reject. Okay, except if you find that maybe if my initial investment increases, my sales revenue increases, and maybe the other costs reduce. That's when my decision may not change. But should the initial investment increase, okay, then that means your decision will change. If I'm looking at sales revenue, because it is an inflow, so meaning that should sales revenue decrease by a certain percentage that I would have computed, okay, and the other variables remain the same, then that means that my decision is going to do what? Change. Okay. So basically for costs, for outflows, look at them. In other words, when you're concluding to be if they are increasing, but then for inflows, if they reduce, in other words, they decrease, then it may have an effect on your decision. And remember, we say that the lower the sensitivity margin, the more sensitive. Like in the previous example, you saw that when you computed our sensitivity margin, okay, for each of these variables. Now, if I may begin from here, like initial investment, you see it was 18.9. That is a little bit higher, okay? Because if it is to increase by 18.9, you see it is a little bit high. Contribution 9.5. You come to fixed cost 23. Discount rate 18. Life of the project 'It was what? 18. No, it was 3. Sales volume. This was 1.9. Selling price 1.9. So when you look at this, you realize that the sales volume is more sensitive. Should it decrease? Okay. Should it decrease, then it will have an effect on what? On our decision. Okay. So that is sensitivity. But of course, as I said, this sensitivity, of course, has got, of course, advantages and disadvantages. Okay. And one of the advantages is that there is no complicated theory to understand. No complicated theory to understand. So meaning that it is very simple to calculate. You have seen calculating the NPV and then coming up with the sensitivity margin. Very easy. Then also another strength of this sensitivity is that it identifies areas that are very critical to the success of the project. So meaning that if the project is undertaken, then those areas can be carefully monitored, especially those that you see are more sensitive. So meaning that any slight change may really make your project not to be viable. You monitor, you critically monitor those areas so that there is nobody messing up. Anything that is going to lead maybe to decrease in revenue, any activity that you see will affect your sales revenue, you don't tolerate it. Okay? Anything that is close. So mean that those areas which are critical to the success of the project are easily monitored because you can easily identify. Okay? Then it also indicates just how critical are some of the forecasts which are considered to be uncertain. So those are some of the key strengths. Then weaknesses, some of the weaknesses is that one, it assumes that changes to variables can be made independently of the other variables. And this is not basically is unlikely, especially if this should be material. If material prices went up, not matter. Okay, so please change that in your notes. So meaning that the farm would probably increase the selling price at the same time, and there would be little effect on the NPV. Because if the operating costs increase, you don't expect the selling price to remain the same. That's why we say that sensitivity analysis assumes that the other factors remain the same. When your costs increase, then the other variables will not change. That is one of its weaknesses. Because you find that if there is any increase in costs, then also the manufacturer will also increase the prices. Okay. So that's why you're saying that it assumes that changes in variables can be made independent of the other variables, which is not the case. Then it is not an optimizing technique in that it provides information on the basis of which decisions are made, but of course it does not point directly to the correct decision. Then also it identifies how far the variable needs to change, but does not look at the probability of such a change. Okay, so those are some of the weaknesses of sensitivity. Now, then we also have another expected values. Okay, because remember we are looking at how you can incorporate risk. Because we said, how can you incorporate risk in investment appraisal? So you can also use expected values. Of course, with sensitivity, we are looking at how to incorporate an uncertainty. Okay, because remember when we were beginning, we say that with risk, you can attach probabilities and be able to predict the outcome. But for an uncertainty, it is not possible. Okay, you cannot mathematically model the outcomes. So You can use expected values also to incorporate risk, okay, especially where there are a number of possible outcomes for a decision. And then you can assign probabilities, each of them, okay? And then an EV, expected value, may be computed. So the expected value is the weighted average of all possible outcomes with the weightings based on the probability estimates. And how do you calculate the EV? Calculating the EV, you need to get the summation of Px. P being the probability of an outcome, and then X being the value of an outcome, okay? And what you need to know is that the EV is not the most likely result, okay? It may not even be a possible result, but instead it finds a long run average outcome, okay? So there is an illustration here. A firm has decided to choose between 3 mutually exclusive projects, the outcomes of which depend on the state of the economy. The following estimates have been made. You have the probability given here. Then you have the project B, project C. Okay? Project A, project B, project C. So they're saying determine which project should be selected on the basis of market values. So we need to compute the expected value. The expected value. So what do I have here? I have project A, EV for project A. So I will get 0.5 times 150 under recession. Because this is recession, and call it maybe R, recession. Then I will add for stable. For stable, it is 0.4 times 400. This is stable. Then I add for growing, which is 0.1 times 300. So this is growing. Then I get the expected value. So I get the EV. Okay. Then I go to, this is, remember, this is project A. Project, this is A. Then I go to B. Project B. So this is 0.5 times 0. Then I add 0.4 times what? 500. Then I add 0.1 times 600. Then I got project C. 0.5 times 180. Then I add the one of stable, 0.4
times 190.
times 190. Then I add the one of growing, 0.1 times what? 200. So I need to save the expected value for each of these projects. And a project which has got a higher EV, okay, is the one that I will select. The one which has got a higher EV. So what is the EV for A, B, and C?
A is 265.
A is
265.
265. Then B,
260.
260. Then C,
186.
So if I'm going to base on the expected values, of course, I will take project what? Project A. So mean that I will select project A on the basis of the expected value, because the project which has got a higher PV, okay, that is what I will undertake. So there is illustration 2. XY company is considering investing 460 in a non-current asset expected to generate a substantial cash inflow over the next 4 or 5 years. Unfortunately, the annual cash flows from the investment are uncertain, but the following probability distribution has been established. Annual cash flow 50, 100, 150. Probability is 0.3, 0.5, 0.2. At the end of its 5-year life, the asset is expected to sell for 40,000. The cost of capital is 5%. Should the investment be undertaken? So now with this, you need to first establish, in other words, having been given the probability, you need to get expected cash flows. Okay. So meaning that here, if the annual cash flow is 50, but the probability of getting that is 0.3. So when you multiply, what do you get? 50 times 0.3.
15,000.
Huh?
15.
15.
15,000.
You say this?
Yes.
Then for this other one?
50,000.
50. Then for this other one?
30,000.
30,000. So having done that, you need to come and, because I say that you evaluate the project at the cost of capital of 15%. So meaning that if the investment is 460, okay, and it's expected to generate substantial cash inflow over the next 5 years. Unfortunately, the annual cash flows from these investments are uncertain, but the following probability distribution have been established. So meaning that you have 15 in 15, then
That is 95.
So the total is what?
95.
95.
Mm.
Okay. So meaning that this, if you're having your layout for NPV, you're going to have the year, you have year, then you have year 0. The initial outlay, the initial investment. Initial outlay is 460.
Yes.
And you're going to discount this at 5%. So discount factor at 5%. So discount factor at 5%. Of course, for year 0, it is 1.
Mm.
So the PV here, the PV is 460. 460. Then I go to year 1.
Year 1.
5. Then you have the annual cash flow. And the annual cash flow in this case is going to be 95.
5.
So you go and look for a 5-year annuity at 5%. What do you get? 5-year annuity at 5%? 3 is what? Go to your tables. That is
It is 4.3.
4.3.
295.
295. So you multiply and get the PV. Do you have a scrap value? Yes. And the scrap value is got in year 5. So you have a scrap value. The scrap value is 40. And it is an inflow. So you look for the PV, present value of 40,000 at 5% for year 5. That is it.
Kindly scroll up a bit.
Huh?
Kindly scroll up the screen a bit.
Yeah.
No. Kasha.
Mhm.
No, I mean down. I thought you, so that we see the working. That was the purpose. Okay.
Yeah.
Yes. Thank you.
So what do you have?
How did we get 40 as scrap value?
Is here. The asset is expected to sell
Oh. Okay, I get it. Yeah, thank you.
for 40,000.
Mm.
The present value is 0.7835.
Present value is 0.
0.7835.
78. So what is the PV for this? Get the PV and then lastly you get the NPV after summing up. You get the NPV. Net present value. Because if I get 95, times 4.3295, that gives
That's
me
4-1. That's 411.
411
mhm.
302.5.
So I can say 303. Then here
31
31
340.
340. Okay, and square value because it's also if
And
when
we
you
have negative 17,
negative 17
357.
356.
Yes.
Is it a negative?
Yes, it's a negative.
This is 464. So that means on this case, the project is not viable.
Mm.
It's not viable. But how can this one be a negative? Because if I get this, it can't
That
be a
plus the lower one, that is 442 643
yes, and this is 460.
60, which is higher.
Huh?
That one is higher because the lower one is 442.
Because
The negative is bigger than the positive.
Yes.
are less
Yeah.
than what we spent.
Yes.
So this project is not viable.
So the conclusion is that the
You
project should
don't-
not be under
Should not be undertaken.
investment. Yeah.
So that means if the NPV is negative, then that means it's not viable. Then the advantages and disadvantages of this technique there deals with multiple outcomes, which is quite different from sensitivity. Because with sensitivity, we're looking at the one variable at a time. But this one, you can deal with multiple outcomes, especially by assigning probabilities. Okay. So quantifies probabilities. Can easily quantify the probabilities, and of course that enables the different outcomes to be quantified. Very simple to calculate, and also offers a straightforward decision. Disadvantages, you know that these probabilities are subjective. They are subjective because sometimes you may find that you have the probability that you've assigned may not actually be right. Okay. Then the EV is merely a weighted average of the probability distribution, which indicates the average payoff if the project is repeated many times. So you can go through these advantages and disadvantages. Okay. I've put a note here. Note the EV decision rule is appropriate if three conditions are met or nearly met. One, there is a reasonable basis for making the forecast. And you can also estimate the probability of different conditions. And also the decision is for a category of decisions that are often made. Okay, because if it is one of decision, then sometimes there assigning probabilities becomes a little bit difficult. But if it is maybe the decision that you've always often undertaken, then it becomes easier. Okay. And then the decision is relatively small in relation to the business. In other words, the risk is then a small magnitude. In other words, if you find that the risks involved are not so high. Okay. So there are other techniques of adjusting risk and uncertainty, and I will require you to go through them. That is a simulation where you have to look at many variables changing at the same time. Okay. Then there is also adjusted payback. Adjusted. Well, I think we looked at payback period. We looked at payback period. So with adjusted, you need to discount the cash flows. If it is adjusted payback, you need to discount the cash flows, okay? So that the risk associated with either maybe those cash flows changing due to inflation or interest loss and business variability taken into consideration. And of course, if you use adjusted payback, only projects that pay back within a specified, in other words, short period will be taken. Now, like here, you have a project which is expected to have the following cash flows. You have the cash flows given from year 1 to 6, and then they are saying that you find the expected payback period. Okay. Then you also find the expected discounted payback period if the discount rate is 10%. Okay. So meaning that here, if I'm to find the expected payback, this is our normal payback. So in other words, you just need to add, because here you see the cash flow stream is not equal. So what you need to do is that you need to add and look for the cumulative cash flows. So if you look for cumulative, what would be the cumulative here? Remember, my cash flows, my initial investment is 2 million. So here I've got 500 in year 1. So here it is
1,000.
Here
1,400.
1 4. Then
2,000. 2,000.
then
2,350.
so basically now you can see that my payback here, the expected payback here will be how many years?
4 years.
4 years. So when you add this,
2,350.
2,350.
Then 2,750.
So that is expected. Now, what about the expected discounted payback period? If the discount rate is 10%, so that means that now these cash flows, you'll be able to discount them at 10%. So you are going to discount these cash flows at 10%. So in other words, you're going to look for 10%, and you discount these cash flows, okay? And then you can look for the cumulative and see the payback period. So that marks the end of investment decision. Unless you have some issues on investment, but those are our next for financing, and which I say that you should go and really go through. I don't know whether you've taken time to go through this financing decision, okay? Because much as you invest, okay, you need to think of how you are going to finance your investments, okay? Where are you going to get the money? And of course, what proportion of the total pool of funds should each source take? Because you find that in most cases, you do not use one source of finance. You employ a mix. There is a combination of either debt or equity. And maybe debt can be from short-term borrowing or long-term borrowing, okay? And maybe equity, you are getting the money from the shareholders, okay? So this is a very,
I
very
have a
key.
quick question.
Yes.
Before we go to financing, when we are calculating for the payback period using the discounting method, do we consider the year zero or we do not?
When you are, when you are, yes, when you are computing
You
the,
see, like the previous example, we have not added, like on the cumulative cash flows, we've not added year zero. So do we do the same when we discount?
now when you are discounting, of course, you will not discount the cumulative, you're going to discount this. Eh?
Yeah.
You are discounting these cash flows.
Yeah.
So after discounting them, whatever you get is what you add cumulatively. And of course, the year zero, you will not, because this is what you expect.
Okay.
So mean
Thank
that
you.
you will begin from year one. Begin from year one. Please don't discount these ones, because these ones will help me get my discounted paper. But when you are discounting, discount these cash flows at 10%, then add to get the cumulative. The ones that you've discounted. Okay.
My
First,
question was about year zero.
year zero, don't add. Yeah?
Okay,
Don't
thank
add
you.
year zero. Because that is what you expect to get. Now, I don't know how many of you have taken time to read through this theory of sources of finance. You have looked at the capital structure debate, the capital structure decision, where we have two schools of thought, the traditional, the neoclassical, MM, especially the financing, in the financing field, the relevance of the capital structure. How many of you have taken time to go through this area? Because the capital structure debate is very, very key. How many of you have gone through this? Can I know?
No, to be honest, I don't think we have had the time because of the current clashing of courseworks and proposal development. That's the
Because you
plain
need
truth.
to, when you look at this, really there isn't much, there isn't any single calculation. These are basically theory. So I expect that you have gone through it and then maybe we discuss some issues that may not be clear. Because you see now, we have up to the end of this month. Today is what? 18th. Today is 18th. So please take some time, go through the financing decision. Look at the capital structure debate, where we have two schools of thought: the traditional, which say that the capital structure decision is relevant, and you states that you can influence the value of the firm by judiciously changing the proportion of debt to equity. Then you have the neoclassical school of thought by M.M. Odgerian and Miller, which argues that the capital structure does not matter. So look at the traditional. What are they saying? So meaning that you can influence the value of the firm through its impact. The financing method can influence the value of the firm through its impact on the firm's cost of capital. So meaning that at lower levels of KO, the value of the firm will be high. Because you find that the cost of debt is generally lower than the cost of equity because of the tax shield advantage. Hence, you employ more debt, the less cost of debt. Hence, KO, the cost of debt will fall. However, when you use more debt, you find that if a company employs more debt, it is possible that KE will begin to increase because shareholders will perceive more risk with increased debt and eventually may require a higher return on investment. Hence, KE will in turn increase because if you are going to invest in a company and you look at its maybe statement of financial position, yes, the company has got assets, but then you find that most of these assets are financed by debt. What will happen if you are a lender? That means that you attach a higher value to your equity, the money that you're going to give them, because you perceive that company to be more risky. And even sometimes you find that maybe those assets, you can no longer use them to secure what? Okay. But the other positions of Modgerian and Mera, who argued that the capital structure debate is a mere detail, that you cannot affect the value of the firm simply by the way you finance its assets. So they argue that the value comes from assets and that the firm has invested in. Hence the asset mix, which is a function of the investment decision. So meaning that once this decision or investment is made, the value will be generated through cash flows, which wealth is conserved. Okay, and when created, it cannot be decision. And of course, the underlying assumptions for this position of MM. So MM also recognizes that when you use debt, you enjoy tax shields. Because you know that interest on debt, by the way, is tax deductible. The one of you who are can give us more light on that. You enjoy
What
tax
I
shield.
can, yes, Anthony. What I can say is, when you use a debt component in a business setup, you will find the debt comes along with the finance costs, that is interest expense. And in the long run, you will find that interest expense is an allowable deduction before you arrive at the chargeable income. So that's why in a way it becomes a tax shield and it becomes an advantage in a business.
Yeah, that's why you find actually, if you look at something, you say you have profit before interest and tax. So before you tax, you first deduct what?
We normally tax net profit. after considering all expenses, including finance costs, because you normally subject the tax rate
You first deduct
at the net profit.
before deducting the tax. So the tax comes later. After, that's why
Yes.
what we're saying, that the debt enjoys that tax shield. There is that tax shield that you get, you enjoy. So for MM, emphasizes that if you are a financial manager, then you should concentrate on the investment decision, the asset mix, instead of financing. Instead of looking at how you are financing your assets, just look at the mix of your assets, concentrate on that. Because if you employ more debt, then you have that tax shield that you enjoy. But of course, there is also the middle ground, bet, whereby both contributions above in the traditional and the MM, they are extreme. And of course, you find that the middle ground reconciles the two positions, and it recognizes two fundamental aspects of debt financing. One, debt financing as a tax shield. Debt brings about some associated costs, the agency costs and bankruptcy costs. Okay. And the tax shield advantage will not accrue to all firms. For example, you can enjoy that tax shield if you make profits. The bankrupt firm cannot enjoy the tax shield, and the tax shield can be obtained through other means, e.g. tax rebates. Okay. And for agency costs, when debt increases, the debt holder perceives increased risk. Because you find that the debt holders can hardly cater for their interests since they do not participate in management. So in order to protect their interest, then you find that they are setting up their monitoring of the day-to-day management. They put debt covenants, e.g. restrictions on the use of assets. Like I've been told, Stanbic, once you pledge, you take there your asset, they will restrict that asset. You cannot use it anywhere. Like if you are maybe a salaried employee and you got Stanbic, you get a salary loan, assuming I'm earning maybe 10 million, and I get a salary loan where they remove maybe like 3 million and I remain with 7 million, that they even put restrictions on the 7 million. There is somebody working with Stanbic. Can you tell us more about that? Because there is a friend of mine who was telling me, and that you restrict even the 7. I cannot use it anywhere. How true is it? The one of Stanbic has not attended today.
Pardon, may I hear the question again?
That assuming I come for a salary loan.
Okay.
I am earning 10 million. That is my maybe net pay. So
Okay.
if I get a loan using my salary as security, and maybe
Okay.
your deduction is 3, that is my repayment. So you even restrict the 7 million, it cannot be used anywhere.
It is true. There was a directive from Bank of Uganda limiting customers from borrowing, because the negative effects of borrowing are that one is most likely to default, on the first loan, if maybe he or she borrows from another bank and the source of income remains the same, because we are looking at salary. A mere fact that one borrows from us and goes to another bank does not stop him or her from borrowing from a third bank. So at the end of the day, you'll find that the salary at disposal is not enough to service the 3 loans the customer has. So in this case, we brought in a payment solution Africa, which looks at those actually the borrowing behaviors of customers. And before we lend to a person, if it's a salary loan, we base on PCA to determine whether we should lend to this person or not. That's my submission.
But now let me ask you, is it done also by other banks?
Yes, it cross-cuts all commercial banks.
Are you sure?
Yes, very much sure.
Mm.
Although,
Because now let me
some-
ask, why should you restrict? Because now for you, I've already taken your amount. So why should you restrict the person to use the money, the remaining amount, the way he needs?
you know, when we are giving out loans, we base on the salary and a memorandum of understanding that we make with the employer is that you will be banking with us. You'll be the employer will be depositing the whole salary of the employee onto the account that he or she has with us. So we are not only looking at the salary loan. No, we are also looking at liabilities. You know, because if salary is paid and it's 10 million, it increases our liability book. In a case that out of the 10 million, we are only getting like 5, that deviates from the original MOU that we make with the employer. And at the end of the day, we are losing on the liability value. That's my submission too.
But that is what we are trying to say. That you find that there are restrictions on the use of assets. Even
But
they
bottom
put
line
restrictions. Yes.
bottom line is borrowing has got a negative effect onto the customer because we are only looking at one source of income, which happens to be the salary. And mind you, a customer has got you know, other issues to attend to. Maybe someone is married, has got a family, has to pay school fees. Or if you find that even part of the salary is used to get a loan somewhere else, at the end of the day, we'll be constrained and will not pay us. So that's why we don't lend to people who have other loans in other banks.
So if I have a loan in another bank, you don't lend.
Provided if it's salary loan, we can't give you a salary loan. We can give you another type of a loan, but not salary. Yes.
What if a person has got 3 salaries?
Actually, it is presumed that a customer has got one salary. You cannot be employed by more than one employer, you know, under our employment laws. You know, maybe it's a contract, but under the formal employment laws, we expect a person to be getting a salary from one employer. Yes.
Okay, so actually that is the information I've given you, that people are complaining about your bank, which you should take note, especially on restriction of their assets.
We will come with idea. We will come with idea though. We are also under strict guidelines and rules from Bank of Uganda, and we can't go contrary to what our supervisor tells us. Yes.
But how come other banks are willing to give?
What I was saying is, you know, different banks do their way of lending differently. However, bottom line is they are not doing it in the right way. And whenever audit comes in, they have found themselves capable of floating the rules and regulations. And obviously there are fines that are normally paid. But in the face of the customers, you know, they will not see it. But inside, you know, the bank will feel it and may not tell you that you've been sanctioned for doing ABC. Yes.
Okay. So, ladies and gentlemen, I can see it is 10:08. I know there is a group that is going for another class, so I would stop here, but please ensure that you go through this financing decision so that once we meet the next weekend, we handle this financing and then dividend at the same time before we move on to our last two areas. Okay? All right, we can stop here for now.
May I ask before you go?
Mm.
I hate to take you back to the previous class than we covered. I wanted to confirm the tables we are going to use for discounting the payback period. Is it the present value of a single cash flow?
Yeah, because you see these ones are not uniform. So that means you use present values.
All right.
You use present values. As long as you see the cash flow stream is not uniform. So that is PV. You must use PV tables. If it is uniform, then you can use annuity.
Okay, thank you.
All right. So let's meet in the.
Then I also wanted to ask.
Hey.
I wanted to ask, you had actually sent an email where you had said that one of us could actually come and meet you at some place in Kamukuzi, and somehow I just forgot.
Yes,
I don't know how
yes.
else
Actually, there is one person who came. Is it Edodi Samson? I think I saw Samson who came. I gave the recordings to Edodi Samson, but I might also be there today, maybe from 3. And though I'm not yet certain, but I might be there from 3 to 5. So you can, if you happen to be within Marara, you can come. And you can just confirm at maybe 1, then I'll be able to let you know whether I will be there or not around 3.
Okay.
Okay.
So.
Okay.
Nice presentations, guys.
I actually thought we'd go through some bit of practice. If people are up for it.
But who made me number 1?
Because you write. No, because
your parents made you number 1.
Yes.
Parents Agava made you number 1. Agava.
starts. The alphabet. How can you make me number 1?
Dr. Linus.
I didn't see Atugonza on the list. Where is he?
Atugonza should be number 1.
Yes.